go. Hello there. Welcome back to My Life as a Landlord. I'm your host, Dr. Jen, and whether you are a newbie landlord, a landlord in a pickle, or a seasoned property manager, my goal is to help you educate yourself and find solutions for your housing confusions. Today, we're taking a slightly different angle. We're going to talk about a lot less about the day-to-day grind of being a landlord, including leaky pipes, tenant screening, location-specific laws. But what are the benefits of real estate without the 2 a.m. emergency calls? Isn't that what everybody is aiming for? And what if, like most of you, my Canadian listeners, you want to take your capital across the border into the States? My guest today is the co-founder and chief investment officer of CPI Capital, a real estate private equity firm. August started right where many of us did as a real estate agent and a guy building and flipping custom homes in British Columbia, right where I am. But he realized that true scalability meant going bigger and going passive, which we'll talk about. I have interesting views about passive investments. Today, he and his team have closed over $225 million in U.S. multifamily assets, and they specialize in helping Canadian and U.S. investors access high-yield, passive real estate syndications. Welcome, August.
Thanks for having me, Jennifer. I know that you have a connection, obviously, back to BC and Vancouver, but you're in the US, so we share some similarities already. So excited about our conversation.
I love it. I love it. Okay, I gave a little bit of an intro, but give the listener a little bit more on, because you're not in BC right now. You're in Florida. So, like, give us some of the background on how that happened, and then we'll jump into more about what you're doing today.
Yeah, I mean, how it happened as far as me living now in Southwest Florida, Naples, is that over the years, I've convinced a few of my friends to move to the US. Is over the last 20 years, I've been very US centric, if you want. I've been very bullish on the US economy, the lifestyle that exists living in the US to the levels of convincing a few of my friends to move here before I did. But 6 years ago, I co-founded CPI with a couple of great partners with our mandate to acquire U.S. real estate, commercial real estate. We can get into that in our conversation while partnering with Canadian investors. So the lifestyle and our business venture made sense for me to be physically based in the U.S. So my wife and I, 3.5 years ago, we decided to make the move. The immigration process is difficult. The legal immigration process is difficult. If it was illegal, it would be a lot easier. We probably get paid for coming here illegally. But yeah, we made the move. We're living here part-time. And both of our sons were born here. I have a 1-year-old and a 2-year-old, so they were both born in the U.S. But yeah, that's about how I end up find myself here in the U.S. currently.
Very cool. Oh my goodness. Well, so at some point, you were swinging a hammer and doing a whole bunch of work up here in BC, and at some point you kind of stopped and you went, something changed. Tell us what changed and why you founded CPI. Like, tell us there was definitely an aha moment there. What was it?
Yeah, I was a builder, developer, if you will, of single family homes. So I was a spec builder and a custom home builder. So what that means is, as a spec builder, you're really acting as an investor. You buy a piece of land, you build a home on it, and you speculate that you're going to sell that for profit for yourself, or if you have investors investing with you. So I did that, and I also did custom home development. What that means is somebody hires you as a general contractor to build them a home to their specification. I did that for a decade. Always entrepreneurial, I always want to scale. My vision is always very grandiose when it comes to the end of the line of what I want to achieve. So I was and being in Vancouver, living there most of my life, I saw the growth of Vancouver. The real estate prices in Vancouver from 1995 to 2015 went up 500%. So a home purchased in Vancouver, or maybe not the city of Vancouver itself, maybe in a little bit of the outskirts, maybe in the suburbs, a home purchased for 200,000 in 1995 by 2015 was worth close to $1 million. And you can see that median home price in Vancouver currently is $1.7 million. So I saw that growth, but that growth wasn't only in the price appreciation of single family homes. That growth was in the landscape of the downtown Vancouver, the downtown core, or other major cities like Burnaby and other cities where you saw these high rises going up. So I saw the infrastructure being built. I saw the population growth, and it was very exciting as somebody who was in construction, seeing these mega projects going up. And I always wondered how this was possible because as a home builder, as a spec home builder, you need at least to be comfortable in the most minimum case, you need at least one third of the total project cost. So if you buy a piece of land for $1 million and your construction cost is, let's say 1.5, you're all in for 2.5, you need around 800,000 or more in cash to feel comfortable, doing such a project. In cases probably even more than that to be more comfortable. So when I saw a $200 million high-rise project going up, I'm like, these people, for them to have, they have $70 million cash on hand to do this. This is going to take me a few generations to achieve that. And that's exactly what it was. You look across Vancouver, you see a lot of these large companies. They are multi-generational. If you see, for example, the Bosas, the Acolinis, the Buccis, a lot of these companies that are there, they started, their family came over from Italy in the 50s, in the 40s and 50s, and now their grandkids have taken over and are building these structures. So it felt very unattainable. It felt this goal that I had, my grandkids were going to hopefully build high rises at some point. But as I explored more, as more content became available online, a lot of educational podcasts, obviously such as yours and others, a lot of educational books. I learned about this concept of private equity, the ability to raise capital from members of the public and do it compliantly, do it legally, and that there is a mechanism and a structure to do so. In the real estate world, they're called funds or REITs or syndications or joint ventures, ability to be able to raise money from people and be able to do bigger projects. And I really, soon after that, I realized that is the way for me to expedite that timeline. Instead of it taking a few generations, I could do it in a few years, possibly, as long as I build a great company with great partners. So that was really the impetus behind CPI and the founding of the company.
That's amazing. Well, before we shift into private equity, I wanted to ask you about something that I've known that you've mentioned a couple times in other media, something called the sunk cost fallacy. What is that?
Sunk cost fallacy. For us, I have to preface it and lay a background before I can get into sunk cost
Okay.
fallacy. But on a high level, sunk cost fallacy is when you have invested in an idea, in a venture, in a plan so much, you're so invested that it's difficult for you to walk away, even though you know that your plans are futile. So that's on a high level what sunk cost fallacy is. And now, why has it come up in my conversation with myself or CPI is because we founded a company in 2019. And we all know that soon after was COVID, a cataclysmic event where it shut everything down for a while. And same thing with real estate and the economy, everything shut down. But soon after, the central banks around the world started reducing rates, in some cases zero. Their Fed's funds rate went to 0.25. And it created a lot of cheap debt and liquidity. So a lot of investors, be it developers or acquisition groups, went out there and bought a lot of deals. So for us as a newer firm, it was very difficult to buy deals when everything was shut down or try to get involved in deals as a newer boutique firm when rates were low and money was rushing into the space. It was difficult to compete with larger firms. And then soon after in 2022, when inflation went out of control because the banks printed too much money, the central banks have really one mechanism to battle inflation, and that's by increasing the central bank rate, or in the US it's called the Fed's funds rate, or in Canada it's called Bank of Canada rate. They raised that rate to slow down the economy, to slow down inflation in turn. So from 2022 to 2024, it was hard to do any deals because the Fed was on a tightening cycle and increasing rates. You couldn't really do any deals. So we really went through this tumultuous times over the last 6 years while building this company, even though it takes usually a decade or more for a real estate cycle to turn. I believe we've been through at least 4 or 5 real estate cycles so far. So it brings the question, if you haven't really hit critical mass in building a company, building a startup, are you in that sunk cost fallacy situation where you are so invested that it no longer, that you psychologically you feel that you still keep going, but you shouldn't? I don't feel that about CPI. I mean, I believe in the company. I believe in the problem we're solving. I believe in our current investors, our current mandate, and the great partners and infrastructure we've built. But that's really the connection between sunk cost fallacy and startups, really.
Very cool. Wonderful. Well, thank you for that explanation. That's amazing. Let's talk about the cross-border dynamics. You're in Florida. You're also looking at, multifamily deals, all kinds of different deals. We can get into the deals that you're looking at now, but you're looking at Canadian investor support. So how does that actually work with RRSP eligible structures, and like what are some of the biggest hurdles that Canadian investors have when they're wanting to invest with people like CPI?
Yeah, so we're talking about basically limited partners or investors looking to invest with an investment firm. In the case of CPI, particularly for Canadian investors, because we are a Canadian firm, because our main offices are in Canada, because the company initially started with its mandate to help Canadians invest in US real estate, we really cracked the code on how to achieve that. Now, initially at the beginning, we really copied the model from, of a couple other handful of companies that were allowing Canadians to have exposure to U.S. real estate multifamily. But soon after, we realized that their model was not the most optimal model. They forced their investors to file U.S. taxes and deal with the IRS. Canadians already have enough headache dealing with the CRA. So we created a structure where it circumvented the need for Canadian investors, for our investors to have to file U.S. taxes. The partnership files on their behalf, and all they do is they have to file with CRA the profits they've made on the US side. So that's a quick high level there. But I mean, when you look at if you're looking to do cross-border LP investing, limited partner type of investing, that as is known in Canada, the exempt market, or as is known in the US, the private placement market in the US, where groups like us source these deals, package them up, create the legal infrastructure, create the legal mechanism for investors to be able to invest in these deals. A couple of important points that come up. One is taxes, right? We are governed by different tax bodies in Canada and the US. And the other is a compliance side when it comes to securities compliance, because those are, again, two different bodies that oversees that. So as an investment firm and as an investor looking to invest with a cross-border investment firm, those are paramount items to look at. One is taxation. Is there a possibility for double taxation? Is the investment firm remedying the concerns when it comes to double taxation? Is the structure tax friendly? The other side is a compliance side. Is the investment firm utilizing the right exemptions or right legal and security compliance mechanisms to be able to raise capital in Canada for these investors to be able to invest in the US? So yeah, happy to get into it more, but I'll stop there.
Wow. Well, knowing what the rules are, I mean, I always say know the game, play it well. But knowing what the rules are is really a great way of overcoming objections, especially with people who are, putting their money where they don't necessarily know what the game is. So that's pretty incredible. Let's shift gears here for a second. There is a term that I saw recently that I really want to talk to you about called the interest rate hangover. Now, you've already mentioned it a little bit, but that term is so interesting. Tell us why you named it that.
Interest rate hangover? Was that? Are you sure that was a term that I have token in any way? Is it interest rate
You know what?
hangover?
It may have been a CPI one, maybe not you, maybe Ava, but
Okay.
yeah, there was some discussion about that, about the end of cheap debt,
Yes,
and
yes,
and
yes,
so
yes.
this is where it's kind of like, okay, now what, right?
Yeah, no, absolutely. I mean, you're talking about debt is such an important component of real estate.
Right.
Other asset classes have, but particularly real estate, because you can't go out there and borrow money to buy stocks or other investments. But real
No.
estate is very conventional, is very standard, it's very industry standard to borrow money and get debt and buy real estate. It's very normal, right? Be it
Mhm.
on the retail level, be it on people, consumers buying their home, or be it on an institutional level. And both residential real estate and commercial real estate are both very sensitive to interest rates. So when your interest rates go up, historically, real estate prices have come down because it diminishes the purchasing power of people's capital to be able to buy deals, right? It's very common sense math 101. But with interest rates today, even though they're relatively speaking high, when you compare them to historic numbers, they're actually pretty low today. But I have to kind of, again, give a background. So the US, there was a great financial crisis, the subprime mortgage crisis in the US in '08 that nearly collapsed the US economy. And there was bank failures. Obviously, some of the larger banks in the US failed. There was bailouts. The US government had to step in and do bailouts. And it really affected the whole world. It had a seismic effect to the whole world economy. And US has the largest economy in the world. So when it went through that difficult time in '08, it resulted in the interest rates being kept low to help the economy rebuild itself. So interest rates from '08 all the way up to 2019, they were fairly low, right? The Fed's
Yeah.
funds rate, which really sets the mark for other banks to be able to lend money to consumers and other borrowers. So we were in this loose cycle of the economy from 2008 to 2019. But so a lot of investment groups got really complacent because they were able to borrow cheap debt, which financially engineered their returns for them and their investors, and they got complacent. One of the ways that a lot of investment groups were able to financially engineer the returns for their investors was by putting on short-term floating debt on their deals, which increased the loan to value. It is more risky, is more high octane, but on the surface, it showcases that there's higher returns. The deal has more meat on the bones. So by 2019, you already could feel that there was some cracks and shifts in the market that we were coming up for a correction because real estate continuously goes through these cycles: recession, recovery, expansion, and hyper supply. So by 2019, we were already between expansion and hyper supply. But soon after, COVID came in and threw a wrench in the whole engine and reset everything, really. So we were already in for a correction. So that correction that was about to come culminated with COVID, resulted in this space in the current phase of the cycle that we are. Recession phase of the cycle is usually 1 or 2 years. Currently, we've been in somewhat of a recession phase since 2022. So it's been 4 years that we've been in this recession phase. In the US, commercial real estate, particularly multifamily, has corrected 20 to 40% in certain markets. Markets like Jacksonville have gone down 30 to 40%. Other growth markets like Dallas, Fort Worth, Phoenix, Austin, even San Antonio, Houston, the prices have reduced for multifamily, for rents as well, because there was lots of oversupply that came online, which has a downward effect on rents. So when it comes to this concept that the hangover, I believe you mentioned, as far as interest rate is when investment groups or investors get comfortable with interest rate being a certain place, they have a hard time factoring in or underwriting to a future interest rate that could be different than where you're at. Now, there are mechanisms in loans to be able to insulate yourself from interest rate volatility. For example, residential mortgages in the US, their term are 30 years. So unlike Canada, when the term is only 5 years, residential mortgages in the US are 30 years. So if you can get a great interest rate on a mortgage, which happened post-COVID, you pretty much are getting a lottery ticket because you have a 30-year fixed mortgage at 3%, which inflation is just 2.5%. And post-COVID, we had inflation go all the way up to 9%. So in a way, for those couple of years, people were getting paid to borrow money. Commercial loans the terms are a bit lower. So you have them from 3 years all the way up to 10 years. Obviously, is a higher interest rate the longer you go on the term. But again, the investor or an investment firm has to factor in where the interest rates will be in the near future. And if they are sunshine and rainbows and more aggressive on those numbers, they could find themselves in trouble, which what happened to a lot of investors who had got comfortable and complacent with low interest rates from 2008 to 2019.
Yeah. I always say check your assumptions. And people, exactly what you're saying. A lot of groups just said, we're assuming that the interest rates are going to stay where they are. Or if they go up, they're going to go up very slowly, right? That's part of their assumption. Always check your assumptions, right? When you're even doing your underwriting, is the assumption conservative or aggressive? I think a lot of people at that time were underwriting thinking that they were being conservative, where they were making assumptions that were actually probably more aggressive than they wanted to be, certainly than their investors wanted to be. You
Yeah.
mentioned locations, August. Let's talk about how you and your group figure out market selection. When you're trying to figure out an area to invest in, what's some of your criteria?
I mean, it's difficult to try to beat Florida and Texas. They both have a huge number of population. Their population is individually more than half of Canada's population, just in Florida and Texas alone. Their economy is extremely large. Florida and Texas individually, again, have a larger economy than the whole country of Canada does. The infrastructure that's there, the interest rate migration that's taking place, the international migration that's coming in. So it's really hard to beat Florida and Texas. And there's so much movement and there's so much transaction taking place that if those are your focus markets, you should be in a decent position. Now, what cities within those markets, right? So for example, when we entered the Florida market, we were looking at where do we want to be in Florida. So we looked at Jacksonville, we looked at Tampa, we obviously looked at Southwest Florida, Naples, Sarasota. We looked at Fort Lauderdale, Miami, and so on. So Miami in Florida is more like Toronto per se, or Vancouver or New York or Los Angeles is a big metropolitan city. It's difficult to make multifamily deals really work because the rent to value ratios are just too low. The cap rates are too low on an apples to apples basis. There's not enough yield to buy multifamily in Miami or surrounding area. So that market was completely out. So next we started looking. No, that doesn't mean that doesn't work for other firms or larger REITs or what have you, because their mandate is different, their terms are different, and so on. So their return profile is different. But for an investment firm from like CPI, we're looking for yield and the upside that we can create through market appreciation and force appreciation. So we looked at Tampa Bay, Jacksonville. Those are the two primary markets, two of the larger cities in Florida. But the issue that we found with Jacksonville is just that Jacksonville is the largest landmass city in the US. There are these belt highways that go around the city. You can get anywhere in the city in a matter of 20 minutes, but there's just so much land. And one big concern with real estate, particularly in the US, particularly in the Sun Belt, is oversupply. When there's a lot of land, there's no the area is not landlocked like the Toronto or Vancouver's. People can just build whatever they want, and that brings too much supply on, which has a downward effect on rents. So we decided not to invest in Jacksonville, and we started focusing on Tampa Bay because Tampa Bay is just a great market where it is. A city of 3.2 million people, the live-work balance. Not only retirees are moving there, but younger people are moving there. There's new companies coming in, Fortune 500 companies. So we really loved what Tampa Bay had to offer, and yeah, that's where we've been focused currently. We own a deal in Tampa, in the St. Petersburg submarket of Tampa. So that's one of our primary markets in Florida. And then in Texas, when people think about Texas, when it comes to real estate investing, they always think about the three major cities. So DFW, Houston, and Austin, those are the three major cities that always come up. And the sleeper city is always San Antonio. San Antonio is an hour away from Austin, and a city of 2.8 million people. And we loved what was taking place in San Antonio, the population growth, the public-private partnerships and infrastructure going up, the raised highways that are being built. If you drive around San Antonio, you really see that hustle and bustle and infrastructure going up. So we really fell in love with San Antonio, and we're currently building a build-to-rent project in the Helotes market of San Antonio. Those two are our primary markets now. Are we hyper-focused on these markets? Absolutely. But we are open-minded on other markets that come up and potentially look at those markets as well. Now, we own assets in other areas, but currently our focus markets are Tampa Bay in Florida and San Antonio in Texas.
Fantastic. I have a San Antonio connection as well, August. I know you don't know me very well, but my mom lives in New Braunfels. And
Oh,
so
wow.
we're right in between. So we are
Yes.
actually in Texas a lot. And I know my regular listeners will go, yeah, she knows a lot about San Antonio. So
Yes.
I've got a lot of folks, especially in that I-35 corridor,
Yes.
keep
Yes.
it right heading up to San Marcos. Anywhere near a Buc-ee's is always a win, right? Like there's
Yes. No, but
there's
what what
always
what what they're predicting is that over the next couple of decades, that San Antonio and Austin will actually merge the way that
Merge.
Dallas and Fort Worth
Yeah.
merged. And New Braunfels is evidence of that exactly taking place because it is a city between the two major cities that's doing tremendously well. So we looked at
Yeah.
some projects actually in New Braunfels.
Well, I always have to laugh because where my folks live now, they're almost to Bulverde. And so I know sorry, listeners, if you're not familiar with San Antonio, we're just going to take a tangent here. But my parents recently traveled. They actually took a cruise out of Miami and they traveled all the way up into St. Lawrence River and went down to Quebec City. And so they were trying to figure out flights, and they actually went in and out of Austin, which doesn't surprise me, especially when they came back. They took a transfer over to Montreal, and I think it was an Air Canada flight direct Montreal to Austin. And then they just they hire a car to go and get them, and the guy was waiting. I mean, so it's about an hour and 10 minutes from Austin, but you have all these international options, which is very much like Dallas Fort Worth, right? It's very, very similar. And I think that we're going to see that fill in really, really over the next, 15, 20 years, even moving forward. There's a lot of people expanding in San Antonio. Every time I go there, it's always more built up. Things move so fast. Absolutely the opposite extreme than Hawaii. Hawaii is glacially slow. It's really, really sad. But thank you for telling us a little bit more about your criteria, about how you look at things. And you mentioned your built to rent philosophy. Let's talk about built to rent, single family rental. A lot of my listeners are small time operating landlords. Not all of them, but some of them are. Various experience levels. Some of them are newbies, not biological age newbies, but newbies as a landlord. But then I've got also 25-year-olds with a big portfolio that are quite seasoned landlords. So let's talk about the purpose-built, built to rent community differing from just like a traditional neighborhood. Why is this asset class booming now?
Yeah, no, I mean, the reason the asset class is booming is because of the consumer that occupies that asset class, which is renters by choice in the US. These are individuals who afford to purchase a home. If not, they can easily afford to live in an A-class apartment community. But the built to rent model really serves them because in a built to rent setting, they're living in a single family home in most cases, if not at least a duplex. They have a garage or a couple of garages. They're living in a community of other people who are renters, nobody living above them, nobody living next to them. And they can, if they want to get up and move in a couple of years, they can do so. And they're not limited or they have to sell their home or it might not be a good market. They can just come and go as they please. So it really serves that market, which is continuously growing in the U.S. with a new generation of millennials now, having housing formation. A lot of them are deciding to rent instead of their parents or grandparents who believed in this idea of owning a home. So the U.S. Rental demographic has continued to grow since World War II. So the U.S. is becoming more and more a renters nation. But yeah, to explain build to rent a bit more for your audience, I'd love to take a step back and say where this asset class came from and what was the spawn of this asset class, if you like.
Yeah, please. That'd be great.
Yeah, so commercial real estate is comprised of different asset classes. So multifamily is one asset class under the commercial real estate umbrella. Then you have industrial, you have hospitality, you have retail, you have all these different asset classes. So multifamily is one of those major asset classes under the commercial real estate umbrella. So I want to kind of mention that first. But we discussed the great financial crisis, GFC, and the subprime mortgage crisis in '08, which resulted in the U.S. economy nearly collapsing. It also resulted in single-family home prices in the U.S. dropping by 30% in 2008, 2009, that time period. So home values from post World War II all the way up to '08 had gone up in value every single year. But in '08, '09, they dropped 30% nationwide. So Wall Street is sitting back, large private equity firms, investment firms, they're sitting back and they're watching this collapse and they're realizing that this is just a phase of the cycle, that the market will turn as it always has. They really believe in U.S. residential real estate is the largest asset class in the U.S. I think is over $20 trillion asset class in the US, and the market will come back. That was their bet that they made. It was just that they never had a mechanism to be able to go out and buy swaths of single family scattered sites, because that was the strategy, right? You had to, the homes prices have corrected by 30%. Your strategy is just buy them, hold on to them until the market turns in a couple of years, and sell these things for a huge profit. And especially, you're not buying it cash. You're putting in a down payment. You're borrowing debt. You're, if you put down 30% and the property goes up 30%, you've made 100% return on your money. And then you can rent it in the process as well and have some cash flow returns coming in as well. So that was their strategy. And that's exactly what Blackstone did. Blackstone currently is the largest private equity firm in the world. It has $1.3 trillion of assets under management. Now, a lot of people confuse Blackstone with BlackRock. BlackRock is just an offshoot of Blackstone. BlackRock has over $10 trillion of assets under management, but is measured differently because BlackRock does money management. So a pension fund puts in a couple $1 billion with BlackRock and they manage those funds. But Blackstone funds are actually in assets like real estate, like in the private equity. So it's actual somewhat physical, tangible assets that Blackstone owns in most cases. So it's measured differently. So they're the largest private equity firm in the world. And that was their strategy. They wanted to be able to go and buy as many single family homes as they could. And that's what they did post GFC. They partnered with a group out of UK. They started a company called Invitation Homes, and they went on there on a buying spree and bought 50,000 homes, single family homes scattered across the US. And they found a way to manage these homes through that UK company that did that in the UK, I believe. And they started renting these, operating them. They eventually took Invitation Homes public. By that time, they had already bought 80,000 single-family homes scattered across the U.S. And Blackstone exited. Invitation Home is still there. Invitation Home currently is the largest single-family owner of homes in the U.S. today. And that was really the spawn of institutions buying single-family. But soon after, in 2014-15, prices had corrected. Their thesis was 100% correct. They had made great return for their investors and they exited, but they could no longer buy single-family homes on a penny, anymore, any longer. So they came up with a strategy that, hey, we can start building homes to the specification we want and do purpose-built rentals. So that was a spawn of BTR, where the strategy is you buy a piece of land, you partner with a local general contractor, you build a community of single-family homes or duplexes, you stabilize it, meaning that you rent it out and you occupy it to more than 90%, and then you either put it on the market and sell it to another institution, or you keep it for a few years and you take you take your profits from the cash flow that the property is producing, and then you ride the wave on the appreciation as well. So that was really the spawn of build to rent. The ground zero for this was in Phoenix. So a lot of these projects start being built. And so we at CPI, we really believe in this asset class. As I was mentioning earlier, U.S. is becoming more and more of a net renters nation. There's a demographic that, baby boomers downsizing. They love to live in these communities. The millennials also love to be mobile, love to live in these types of communities. So there's a huge demand that is really allowing this asset class to do tremendously well. So that's exactly what we're building in San Antonio. And we're looking to continue building and growing our footprint in build to rent in different markets.
That is really cool. Thank you for the explanation between Blackstone and BlackRock. I get so confused over all the names and all the branding stuff. It's a little confusing, but thank you
Yes.
for that. Yeah.
BlackRock, so the founders of Larry Fink used to work for Steve Schwartzman, the founder of Blackstone. So Larry Fink came to Steve Schwartzman and actually told them about the strategy that they have, but Steve Schwartzman gave him a cold shoulder. That's why Larry Fink went on his own and actually created BlackRock. And even today, when you read Steve Schwartzman's memoirs in the recent book that he published, he says that one of the biggest blunders he's ever done in business is not pursuing what Larry Fink was talking about, their strategy when it came to asset management.
I get it. I get it. August, let's do a like a retrospective think here. If you could go back to the days when you were just starting out in BC real estate, knowing now what you know, what's the one piece of advice you would give yourself?
It's near impossible to just give one piece of advice, but I can say a few.
Okay.
I would really focus saying getting involved in the real estate in the world of real estate private equity sooner.
Mm.
Definitely having mentors and joining educational groups, mastermind groups. That's something I would have done way sooner. Building a brand around myself, educating myself in the space. I would have definitely done that sooner. Shiny object syndrome. Young people, there's just so much information coming their way with social media and digital matters are coming towards them, so they get distracted, understandably so. But if you can be a specialist and focus on something and dedicate your time and your life to, you'll definitely have success. So those are some high level advice I'll give. But yeah, I love the real estate private equity space because it's the finance world merged with the real estate world, and it allows the ceiling is just either so high or non-existent. You can just build something great, and you can see that with Blackstone, which is the largest private equity firm in the world. They started out as a private equity shop buying companies, but at some point, Blackstone had a larger allocation to real estate than they did to private equity buying companies. So that shows how easy, not easily, but how it is possible to grow and scale in this business.
That's pretty incredible. No, it's great. August, if a listener wants to get a hold of you, how would they do that?
Our website is a great place. There's lots of great information there. We have a underwriting model that you can download if you want to underwrite multifamily deals. We have an educational center there that you can rewatch some of our experts webinar master classes that we hold that is only available on our website, and you can access our podcast as well, Real Estate Investing Demystified, on our website. I'm very active personally on LinkedIn. I'm a LinkedIn top voice, so I create a lot of content on LinkedIn about real estate and the economy. Connect with me on LinkedIn, August Biniaz. I believe I'm the only August Biniaz on there. Yeah, hope to connect with you, and tell me you've seen me on the podcast, and love to connect and chat.
That'd be great. August, thanks so much for joining us today. Any parting thoughts?
Yeah, just stay focused. Currently, we're going through the recession phase of the cycle, so it's a great time to get involved in the market today and believe in yourself, and you can achieve it.
It sounds great. Thank you so much for joining us. Appreciate it.
My pleasure.